Hey everyone, welcome to today's Explainer. I'm Steve. Well, if you thought that long holiday weekend was going to smooth out the macro friction, think again. Today's session just served up a massive, unforgiving dose of institutional reality. We went into the break with this grand illusion of peace, a market practically pricing in zero risk. But the second that regular session opened on Monday, bam, that illusion was instantly shattered by sharp, algorithmic friction. Because let's face it, the tape just doesn't care about our holiday sentiments. Okay, let's dive into this and look at exactly how the mechanics broke down today.
The peace deal euphoria ran directly into a structural consolidation zone today. See that sweeping US-Iran peace framework? It remains the primary structural floor for equity margin models right now. I mean, it literally drove last week's massive short squeeze. But here's the thing. Expectations are one thing, algorithmic reality is a whole different beast. Today, some diplomatic hitching points over in Europe triggered an immediate, systematic repricing across the entire curve. The market basically collided with a brick wall of structural consolidation. Because smart money, it doesn't trade on hope, folks. It trades on hard data and strict risk parameters.
So here's the agenda for today's Explainer. We're opening up the ledger to map out the active forward cycle. We'll start with the terminal scorecard, then hit Swiss diplomatic friction, look at gold's yield-driven flush, break down the crypto leverage reset, and finally, close out with your professional trading directives. All right, Section 1, the terminal scorecard, mapping the active forward cycle. Let's get right into the hard data.
Listen, the tape did not tolerate a single ounce of ambiguity today. If you were caught leaning the wrong way, the machines literally ran you over. So shifting our metrics entirely into the active forward cycle, that means the contracts where the bulk of the actual money is trading right now, here is exactly how the majors settled. September S&P futures, ticker ESU26, spent the whole afternoon defending key intraday levels, holding their ground to lock into true settlement print right at 7542.25. That's up 0.35%. Now dropping down into the energy pits, Brent crude, the active September contract, flipped right back to the green. It surged 3.26% to hold at exactly $91 flat, entirely due to that Swiss friction catalyst. Over in metals, August gold took a severe technical bruising. It broke down 2.04% to settle at $4,236 on rising real yields. And finally, the active June Bitcoin contract staged a really disciplined defensive stand, shedding 1.48% but anchoring a critical support shelf right at $63,200 as leverage was reduced. The real takeaway here? Look at those catalysts. Every single move today wasn't about long-term fundamentals, it was driven by mechanical algorithmic reactions to macro headlines.
Moving on to Section 2, Swiss diplomatic friction. Washington and Tehran headline noise.
To really grasp the mechanical turnaround we saw on the screens today, we've got to look at the incredibly rocky formal diplomatic talks from over the weekend. We started with that holiday peace framework. But by the weekend, talks between Washington and Tehran hit an absolute wall in Switzerland. And why is that? Well, conflicting reports regarding near-term physical shipping rules through the Strait of Hormuz suddenly hit the wire. It's kind of ironic, right? Talks centered on peace are the exact thing that caused today's market chaos. But automated commodity desks, they don't take holidays, and they sure don't debate diplomacy. They just read that headline noise and instantly injected a massive pocket of war risk premium, basically panic insurance, right back into the energy pits. That snapped a multi-day slide in crude oil for sure. The algorithms repriced the curve in actual milliseconds. This sudden return of supply chain headline noise acted as an immediate intraday break on equity valuations, capping all of that post-holiday upside momentum. But hey, it wasn't just geopolitics at play here. We are squarely in the pre-Fed blackout window. The broader market is battling some really intense pre-meeting positioning ahead of Wednesday's high-stakes Federal Reserve interest rate matrix. Because policymakers remain completely locked down and totally silent right now, systematic desks just aren't taking any chances. They chose to peel back their top-tier tech leverage, parking heavy size directly into cash buffers. This forced those automated desks to cap equity momentum and aggressively test core short-term trendline support. In plain English, they are absolutely de-risking the board before the Fed even speaks. Okay, let's pivot to Section 3, Gold's Yield-Driven Flush, Precious Metals Liquidation. I really want to direct your attention to the severe structural damage inflicted on the precious metals desk today, down 2.04%. Let me tell you, gold didn't just bend today, it broke down through heavy traffic. That is a steep, highly aggressive liquidation event that forced August gold contracts to settle all the way down at $4,236. This, folks, is exactly what technical bruising looks like when speculative longs get trapped.
So the absolutely crucial point here is understanding the why behind that massive drop. It really comes down to hawkish bond pressure. We've got dual drivers at work. Fixed income desks are absolutely refusing to let long-end treasury yields back down, primarily because domestic inflation data remains incredibly sticky. This is a direct continuation of those hawkish Federal Reserve interest rate projections. And think about it. Because gold yields absolutely nothing, holding it when interest rates are climbing comes with a massive opportunity cost. With creeping real yields and those Swiss diplomatic talks turning into more of a multi-week grind rather than an instant fix, speculative long positions just had no choice. They had to aggressively unwind their exposure, forcing bullion to retest its core long-term moving average support shelves.
Which brings us to Section 4, the Crypto Leverage Reset. Systematic trimming in digital assets.
Now, while equities and metals face tight distribution, the digital asset tape took a noticeable hit today, and the systematic trimming here was highly calculated. Bitcoin simply couldn't escape the macro drag that was pulling down the rest of the board. On one side, you have centralized crypto friction. The digital tape is working through a fresh layer of international regulatory heat. Reports are surfacing that European central bank pressure is actively stalling major exchange licensing applications. That is pure, structural headwind. Contrast that against the liquid index curves. The capital flows right now are crystal clear, guys. Hot money is temporarily stepping away from centralized crypto infrastructure, and it's moving right back into highly liquid index curves where corporate energy hedges provide immediate, fundamental protection. That exact capital flight is why the active June Bitcoin contract cascaded through local support, anchoring at $63,200.
All right, Section 5, Professional Trading Directives. The Execution Blueprint.
We've done the technical analysis. Now we have to pivot to execution. This is where you need absolute discipline to navigate this sudden risk reversal without letting all that choppy headline noise dictate your trades. So here are your strict technical directives. Listen up. Step 1, stop chasing the intraday noise and trade the hard terminal averages. Step 2, watch the September S&P Futures 20-day simple moving average. Today's closing print of 7,542.25 keeps price action locked in a really tight technical battle right around that line. Step 3, defend the absolute line in the sand, the upward-sloping 50-day exponential moving average. As long as the 50 EMA holds on a weekly closing basis, the structural bull framework remains protected. And finally, Step 4, keep your position sizes tight and ruthlessly enforce your trailing stops. Let the levels do the talking.
And here is my final warning for you before we wrap up. Keep your eyes pinned to Brent crude oil. Watch that $91 level like a hawk. If oil remains contained near 91 bucks, despite the ongoing Swiss headlines, the broader index is going to find the stability it needs. It will carve a firm bottom right there ahead of Wednesday's Fed statement. Energy is the anchor right now, so whatever you do, do not take your eyes off it.
We've mapped the friction, we've tracked the capital flows, and we've set the defensive parameters. The tape has spoken, and the ledger is locked tight. So the only question left to ask is, are you ready for the morning bell? Stay disciplined out there, and I'll catch you on the next explainer.